We're going to talk commodities. We're going to go to London to do that. Right now, Alex Boss joins us from Macquarie. Good to have you here.
Thank you.
You look at corn and commodities. Let's bring up copper right away. We're going to really spend a lot of time on grains, but I thought this was fascinating. A surge beyond 2008. As you know, Alex, copper has blown right through the highs of nominal highs of 2008. Do the grains have the potential to do that? Do we have the potential to see wheat or corn really surge out beyond where they were in 2008?
I think definitely corn has that potential. In fact, we've already seen corn make new all-time record highs this week over and above the 2008 highs. So we've seen more of a doubling in corn prices since June of 2010, and yet it appears that demand for corn continues to accelerate, particularly for ethanol and on the feed sector side as well. So I think certainly corn has quite a lot of upside yet from here. Supplies look critically low. And we're basically already there in terms of all-time record highs for corn.
Ethanol distorts corn. How much does ethanol distort wheat and soybeans?
To a lesser extent. I mean, for wheat, wheat will have to follow corn prices higher because it is a substitute in feed rations for livestock in the U.S. And in other major countries that produce livestock. But at the end of the day, ethanol is really a corn story. For soybeans, soybean oil, there is some impact on the biodiesel side. However, biodiesel economics have been relatively weak over the past year, so we haven't seen a huge amount of biodiesel production actually ticking through the system.
I see.
So ethanol today is really a corn story.
Well, I see these pictures, folks. I want Ray Liotta to walk out of the cornfield like he did in Field of Dreams there. That's what it looks like to me. Let's look at this chart, folks. We've showed it to you for the last 10 days or so. We're trying to put together a set of charts with long-term historic perspective. This goes back to 1900. It's inflation-adjusted food, Alex Boss. And you see the gift that we had in the past decade, and up we go. Do you agree with the agriculture professor at the University of Illinois I talked to, Scott Irwin, that we can see corn at $10 a bushel?
I think that's a risk, certainly, particularly if the planting season does not go well. What we're seeing right now is farmers tentatively starting to work their fields. There's some field activity going on in particularly the southern Midwest. However, in certain areas of the U.S., particularly the northern Midwest states, so I'm talking the Dakotas, Minnesota, Wisconsin, there's still a lot of snow up there. And in the USDA's numbers released last week, it looks like a lot of the corn acreage increase that needs to happen this year is expected to happen up in those states. With a lot of snow cover up there and with some ideas that the spring planting season might be cooler and wetter than normal, I think there's certainly some risk that not enough corn gets planted. If that happens, I think we have a serious problem developing on the U.S. corn balance sheet. I think that opens up certainly upside to $8.50, $9. In kind of a worst-case scenario, certainly $10 becomes possible.
And right now, for those of you living in Manhattan, corn $7.60 per bushel. Alex, you guys are paid to worry. That's what you do in the agriculture business. But, you know, I look all in all at the corn planting and, you know, pesticides and all that. What is the shape of our existing stock? What is the shape of our inventory of corn right now?
So for corn on the U.S. balance sheet, the USDA, its March figures suggest 675 million bushels. That's roughly a 5% stocks to use. That's nearly unprecedented in the history of USDA analysis. And going straight back to 1995-96, the last time we saw a 5% stocks-to-use balance sheet. However, what happened last week on the quarterly stocks report released by the USDA basically was a suggestion that demand continues to accelerate despite this high-priced environment. Essentially, that means feed demand is running higher than the market expectation coming into that report. It does suggest that the USDA might need to move that ending stocks figure for the total marketing year down at least another 100 million bushels. So that puts us actually closer to a 4% stocks-to-use ratio. It literally suggests that in some areas, at some point into August, September, that the U.S. market will be running out of corn, potentially.
Bring up that chart, folks. This is a great chart. Chart 9, Rex. Corn distorts soybeans and wheat. We talked about this earlier in the segment with Alex Boss. This idea of prospective planning, gaming how many acres will be planted. This is the U.S. Department of Agriculture. Their guesstimate, it's an explain this. Yeah, I know nothing about corn. Alex, how confident are we that the USDA can keep track of each acre? I mean, are they guessing here, or is this really pretty good math?
Well, I think it's important to remember that the March planting intentions report is exactly that. It's an intentions report. So it's literally a farmer survey of what farmers in the U.S. expect to plant. We historically have seen some major differences between what the March report reveals and what the June 30th acreage report reveals. And what the June acreage report does is look at more quantifiable data in terms of exactly what has been planted after the planting season has finished. So the concern right now is that 92 million acres for corn, for example, looks relatively comfortable. But if we do not have a good planting season, that number could very well decline into the June 30th acreage report. So I think there's some confidence today in the USDA's numbers, particularly if you look at relative economics for planting corn. In our analysis, we think corn returns per acre relative to soybeans are at one of the highest differentials we've ever seen in history. That's well over $100 per acre advantage corn over soybeans.
Absolutely fantastic.
So the numbers make sense.
Alex, we're going to come back. Alex Boss with us from Macquarie. John Baumgartner is going to join us from Telsey Advisory. Why is a corn expert in London? Would somebody send in an email on that? Alex Boss with us, folks. Macquarie in London. We're talking corn, wheat, soybeans. And joining me on stage here, John Baumgartner with Telsey Advisory Group on stores. So the two of you were here, and you got different views of the. John, let me start with you first. Oil up, food up. What does that do to retail America when you see the kind of inflation we've got?
I think it's clearly a pressure point for the consumer. We think in the food space, you could see consumers cut costs in the food space, specifically buying private label. A lot of our consumer research does show
they're going to shift to private label.
We think so, yes, as well as being very value-oriented, discount-driven, promotion-oriented in the food store. We have seen that in our consumer surveys pretty consistently for the past few quarters. We think that could be an area where we see pressure.
Alex, what is the elasticity of corn? I mean, we talk about the oil is inelastic. You're gonna buy it whether you need it or not. Do people cut back on corn or soybeans when they get expensive?
There should be some demand response at some point. We have not seen any major demand response yet throughout this entire corn rally. Where it needs to happen, in my view, is either in ethanol or in livestock feed demand. Both those sectors are extremely difficult to ration corn demand. For livestock, for example, all you have to do is look at the live cattle futures chart. It basically says that the livestock price is trying to keep up in tandem with the corn price increase, to keep farmers in positive margins, to keep farmers using corn, and keep farmers basically producing livestock. So at the end of the day, we've seen very little demand rationing there yet, but I think it can happen. What farmers can do is feed their hogs or their cattle to lighter slaughter weights, so they can bring them to the market at lighter weights, which essentially uses less corn.
I have been dying to ask the two of you since we put this half hour together the question that we ask economists, and they all go, food doesn't matter, it's separate from core inflation and all that. John, let me start with you. Are the economists nuts, as all my viewer mail is? I mean, food inflation, oil inflation, when it fits into Dana Telsey's work and your work, it fits into retail, it's got to affect people's pocketbooks, doesn't it?
I mean, I think it does. I mean, I think if you look comparatively the U.S. versus emerging markets, the percentage of your income spent on food is less than it would be in countries elsewhere in the world. Right. And I think, secondly, the retail price of food, your actual raw material, is a fraction of the retail price on the shelf. You have other expenses such as marketing expense, logistics, transportation, packaging. That all inflates the price of food through the supply chain. So I do think that the U.S. consumer is less immune to increases in food prices, although it still is an issue. It's not 100% immune.
Separate. Okay, Alex, in London, in Europe, they look at food, they fold it into a headline inflation analysis. With your years of work on corn and wheat, should the Fed worry about food prices and energy prices?
Yes, absolutely. I think at some point the higher commodity price will feed into higher food inflation at the retail level. It is difficult to say exactly what that lag time is, as most retailers seem hesitant to pass on the high price of food immediately at risk of potentially losing market share. So it's very difficult to say exactly when it will feed through. But if we maintain corn, wheat, and soybean prices at these elevated levels for another 6 months, it has to have some impact.
When you maintain at these elevated levels, how long do we need to keep corn at $8 a bushel?
Well, I think at least for the next 6 months, we're going to be looking at high corn prices. So 6 months, 6 to 8 months into the next corn harvest in the U.S. That's when we will potentially see another supply recovery. Until then, I think high corn prices really need to do the work to limit the demand in the market and preserve the available supply out there.
15 seconds, Alex Boss. I'll give you the last word here. We'll come back with John. What price of corn changes the ethanol debate in the United States?
Well, we saw the food versus fuel debate really gain a lot of fire in 2008. I think it might be coming again. However, we haven't seen crude oil prices really take off like they did in 2008 yet. If they do, that certainly ratchets up the corn price that would be required to actually start rationing ethanol demand.
Alex Boss.
So, in my view, I think it will become more of a central focus in the public's mind as we move into the summer.
Gasoline prices, are they good for Walmart? They sell a lot of gas, right?
Yeah, I mean, I think, as gasoline acts as a tax on the consumer, again, you could see consumers trading down towards discount stores, the Walmarts of the world.
But do the stores make money when they sell a gallon of gas? If it's $3.70, do they make more money net clean than they do at $2?
I mean, in general, it would depend on their pricing in the wholesale market.
Right. Let's look at this chart. Filler up at $4.25. I did the math on this today. This is a new chart. This is inflation-adjusted gasoline, a gallon of gas, set in today's dollars. So that $4 a gallon gas, when you figure in inflation, in today's dollars would be $4.24 and a couple digits. We're really getting up there. I mean, we're really getting expensive, aren't we? I mean, yes. We're back to, are we back to 2008? Can we say that yet?
I mean, I think on an input cost side for a lot of these companies, we can, looking at the year-on-year change in commodity prices for the food companies themselves. Right. I think one of the big differences today that we are seeing is I think the companies themselves are much better prepared to weather this storm relative to 07, 08.
I like that idea. They're a lot better off. They've been through this drill before.
Yeah, I mean, I think you're seeing a much more forward contracting. And futures hedging in these markets, blunting some of the near-term pressure. In addition to that, you've got much more aggressive productivity savings in-house, looking to cut costs elsewhere in the cost structure.
I know Dana Telsey only has Godiva chocolate around the office, but Hershey's up 10% in price. Are we going to see that pass along of those increased costs to the consumer?
Hershey did announce a price increase last week, high single digit across the U.S. portfolio. I think what's on my radar for Hershey specifically is the high gas price in the convenience channel themselves. If that dampens some of the sales growth we are seeing in the convenience channel, maybe it's a little bit of a sales headwind for Hershey this year. In addition, looking at the overall cost basket, dry milk prices, the dairy complex, that's inflationary. Sugar remains at elevated levels. Very key inputs for Hershey as well.
Let's bring up chart 8 here, Kellogg's. I mean, we had a lot of fun putting this together. Everybody on our team has a favorite. What was your favorite childhood cereal?
Frosted Flakes.
Frosted Flakes. Okay, great. He guessed right. There's a chart down here. Break exclusive. John Baumgartner guesses right. Great. Total return. We just guessed that. Okay. Here's a chart. The fact is you can make money at a food stock, can't you?
Sure.
I mean, they just grind it out. And which is the best managed food company?
I would like General Mills.
Why?
The leadership, Ken Powell. He's had very, very good experience globally in the business, running U.S. retail, running the Yoplait business internationally. We feel that the General Mills management team has a very good focus on the U.S. consumer, good innovation prospects, good pipeline and R&D, growing the Cheerios franchise with new innovation.
I was reading about mechanized chicken, mechanically separated chicken. It was not pretty. Who makes private market cereal? Is it made in the same factory as brand name stuff?
No, there's private label producers.
Private label producers. You got to come back. We got to do this more. I mean, absolutely. Food. This is going to be a big deal. I know what the economists say. I'm sorry. That food inflation hurts.